What's going on, investors, and welcome back to the channel. Now, first of all, I'd like to apologize for the uploading of videos being more infrequent than I would like them to be. The reason for that is because the public and private markets are very hot at the moment, meaning that there's a lot of mergers and acquisitions, a lot of activity happening in the markets. As a result of that, of course, I'm very busy at work, meaning that I can't devote as much time to creating videos. But actually, just before we get into the video, comment down below on which stock you would like me to look into next, and whichever stock is mentioned the most, I will endeavor to make a video on that. And I suppose actually that point of the markets being very hot right now is very relevant and very pertinent to today's video, because we can see here that Warren Buffett's Berkshire Hathaway reveals a major stake in HP, and the tech stock soars as a result of that. So Berkshire purchased nearly 121 million shares of HP to become the largest shareholder, and that stake is worth roughly $4.2 billion. So it's clearly not an insignificant investment, although for, by Berkshire Hathaway standards, it's not all that big either. With that being said, right, Berkshire Hathaway have now become an 11% shareholder of the total HP stock. So as a result of that, clearly they're very bullish. And I thought that today would be good to give a little bit of an overview of HP's financials, and to try and give you guys an idea of what Warren Buffett may have been looking at when he was considering about making this acquisition. So if we flick across to Ticker Terminal, we can see that HP has a market cap of $40 billion, total enterprise value of $46 billion. If we go across to their financials, right, I've got 15 years worth of financial data here. We flick across to total revenues. We can see that clearly, right, something happened between 2013 and 2014, which meant that their revenue has halved. So whenever I see a significant decline like that in a single year, so we've basically lost 50% of our revenues in a single year, and that has maintained throughout the rest of the period, it's clear to me that the business must have sold some of its operations or something like that. So there must have been a significant structural change in the business, which has resulted in that decline in revenue. So because of that business or structural change, there's effectively not much point in going back as far as 15 years, because you're looking at a business or operations of a business that no longer reflect the operations of today. As a result of that, it probably only makes sense to go back to 2014, unless you want to get an understanding of something like how management have performed over time, something like that. Anyway, if we look here, they posted $56 billion of revenue in 2014 and only $63 billion of revenue in 2021. So clearly growth for this business has not been great, but from 2016 onwards, it does look like it has been on a bit of a more upward trajectory. And actually in the most recent year, they posted revenue growth of 12%. So there might be a little bit of a turnaround story there, but then again, given the fact that there have been a significant number of sort of wider macroeconomic changes, it's difficult to say whether there's going to be sustained growth over time. And I wouldn't imagine that Warren Buffett does believe that this is going to be a company that's posting 12% revenue growth year over year. In my opinion, this is a business that will probably compound at something like 3 to 4% a year. And it's actually a similar story with gross margins, right? So we can see that gross margins were actually declining through to 2018. And then from there have been a bit of an upward trajectory with a significant increase in 2021. So again, it comes down to the point of, is this new gross margin of 21% the new norm for this business? I don't know the answer to that, but these are the kind of things that I would be looking at. And if you dig into the business, dig into the details of the business, that is something that you may be able to work out. Now, clearly, gross margins of 21% aren't all that impressive, but actually when we go down to net income margins, we can see net income margins between effectively 5 and 10%. Now, 5 and 10% net income margins aren't too bad. It's nothing special, right? It's not a software company where you're looking at net income margins north of 40%. But net income margins of 5 to 10% isn't too bad when you think about the valuation of this business. If we go to the valuation, we look on a price to earnings ratio. We're looking at a price to earnings ratio of just 7. So this is a business that potentially may compound its revenues and potentially net income at maybe 3, 4, 5% a year. We're talking about PE ratio of just 7. The lowest that it was over the last year was 6. And actually, if we go back as far as 5 years, the lowest the valuation has been is just below 6. So if we can assume that Warren Buffett paid somewhere around 6.5 times, because of course the share price rose as a result of him buying the stock, I think that seems like a pretty good deal. You're buying this stock at multi-year low valuations. So whilst this business is not going to see significant revenue growth, it's not going to see significant, net income margins, you are getting a business at a cheap valuation by the looks of things if they can continue on, 3 to 4, 5% revenue growth, something like that. Now, when we flick across to the free cash flow of the business, we can see that this is a very cash flow generative business. And clearly that is going to be something that Warren Buffett is very interested in. Now, although this here shows cash from operations, when we go to capital expenditures down below, we can see that with exception of 2014 and 2015, capital expenditure is very low in this business. So effectively, we're looking at $6 billion of free cash flow in the last 12 months. Now, when you remember that I said that the total enterprise value of this business was around $45 billion, then clearly that is a very good yield. And you're looking at a multiple of about 8 in terms of price to free cash flow. That is very, very cheap. Now, of course, there's no point in generating all of that free cash flow if management aren't going to allocate it correctly. So we can see here that they are using some of it to pay down debt, although they are also issuing debt at the same time. As a result of that, it looks like they are issuing more debt than they are paying down. So I wouldn't pay too much attention to that. Effectively, if you want to see how much debt that they are paying off each and every year, of course, you can just go to the balance sheet. But if you wanted to look from here, from the cash flow statement, then you want to take the net figure of the total debt issued less effectively the total debt repaid. So in the instance here in 2021, they issued $2.5 billion of debt. So that was cash inflow to the business. And they repaid about half of that, which would have been some previous debt. So effectively, they are refinancing here, possibly getting a better interest rate, or it's just the fact that their debt has come to maturity. They have to pay that down, and then they are issuing new debt to bring that cash flow back in. We're looking at repurchase of common stock though, so they are definitely a big fan of share buybacks. That is distributing equity or capital back to shareholders, and then they also pay a dividend as well. So it looks like they're doing the right things. We are going to take a look at the balance sheet though, because it does look like they are continuing to issue more debt than they are paying off. So what we've got here is a chart of total cash and cash equivalents against long-term debt. And actually the balance sheet is looking pretty good. And the reason I say that is because they've got effectively in each and every year around the same amount of cash as they do debt. So at any point, they could just extinguish that debt if they felt like that would be a reasonable thing to do. Given the fact that we are still living in a very low interest rate environment, despite the fact that interest rates are of course rising, we're looking at multi-decade lows in terms of interest rates. As a result of that, I think that it's smart to have some debt on the balance sheet. Clearly that's what HP are doing here. So from a balance sheet perspective, they actually look like they're doing a pretty good job. Now, when we look at the amount of dividend that they pay, it's around 83 cents a share. So it's a dividend yield of around 3%, which is generally considered a fairly healthy dividend. Now, we're looking at a payout ratio of just 15%. So clearly, at least over the short term, over the next few years, it doesn't look like there's any concerns with regards to suspending that dividend, which of course is very good as well. Now, moving on to what analysts are expecting for this business going forward. Now, you may remember that I said that, this kind of business generally tends to compound at something like 3, 4, 5% per year. We can actually see here that for 2022, we're looking at revenue growth of 4%, where we then effectively stagnate for the next 2 years, and then there's a 5% rise in 2025. So it wasn't a bad estimate from me. With that being said, right, for 2026, we're looking at revenue decline of 11%, which looks rather peculiar. In my opinion, what we're seeing here, and I can't actually verify this, I don't believe, but what we're seeing here is that there may have been maybe say 10 analysts that are projecting through to 2025. Maybe in 2026, there's only 2 or 3 analysts that are projecting that far. As a result of that, if they were always sort of bearish on the company, you're going to see a significant sway in 2026, if that makes sense. So I wouldn't pay too much attention to that, given the fact that I would assume that through to 2025, there are more analysts covering the stock. Just my opinion, though, I don't think I can actually verify that. But clearly, I don't think that there's anything known in public knowledge right now that would result in an 11% revenue decline sort of 5 years out from now. So I wouldn't pay too much attention to that 2026 figure. Now, in terms of EBITDA margins, we're expecting for those to remain relatively flat. Now, given the fact that Warren Buffett doesn't care for EBITDA, I doubt that this is something that he would have been projecting for himself or even paying any attention to or much attention to. But yeah, EBITDA margins are expected to remain flat at 10%, with the exception of 2025, where maybe there are a couple of analysts that believe that this can reach 70% EBITDA margins. Once again, similar to the explanation for 2026, I wouldn't pay too much mind to that estimate right there. In terms of net income margins, though, it does look like analysts are expecting for net income margins to fall back to some more sort of normalized levels. So clearly we saw a large benefit in 2021. We're expecting that to slowly decline over time, back in line maybe with the more historical results of the business. So all in all, I think I can understand why Berkshire Hathaway may have made this acquisition. It does sort of fit in with his style of investing, which is to look at businesses that are cheap from a valuation perspective, but that are generating significant profits, significant free cash flows, and then are distributing those cash flows in a way that benefits the shareholder, right? So through not only through dividends, but also through share buybacks, and then also paying back or paying down debt if it makes sense to do so, which at the moment it doesn't make a huge amount of sense, right? But I think that this looks like a decent acquisition. You also have to, not acquisition, a decent investment. You also have to pay attention, I suppose, to what you're expecting for the business going forward into the future, right? So, of course, in this video, we've not even looked at the competitive landscape. Are there other competitors that may possibly take market share from HP, and as a result of that, the results of the business will decline? Obviously, plenty of other things to consider as well. But strictly from a financial perspective, this looks like a fairly good business trading at a fairly cheap valuation. But I'd love to hear your guys' thoughts on this investment. Do you think that HP stock will outperform the market over the next 5 or 10 years? And also, don't forget to comment below on what stock you'd like me to look into next. And whichever stock gets the most amount of comments or likes or whatever, I will endeavor to look into that business. Anyway, guys, thank you for watching. Don't forget to like and subscribe, and I'll see you in the next one.